Welcome back, my friends, to the Mail Right Real Estate Agent Podcast Show. We're on episode 130, and we have a returning guest with us, but for a very important reason. We have a new tax reform to discuss, and so we brought back one of our show favorites, Miss Rachel Ivanovich from Easy Life Management Tax Preparation up in Carlsbad, California, which is part of San Diego County, a very nice part of San Diego County. And if you want to hear Rachel on our previous episodes, you'll find her on episode 91 and 106. Rachel, welcome back to the show.
Thank you, Thomas. Good morning. It's great to be back.
We're glad to have you, especially after what happened in December.
Oh, yeah. It was a little crazy.
Yeah. Well, that's it. We're going to dive into a lot of questions here. We got a lot of content to cover, but I want to let our illustrious co-host, Mr. Jonathan, sign in with our guests. Jonathan, good morning and welcome.
Oh, hi there, folks. Yeah, it's Jonathan Denwood, the founder of Mail Right, which is a platform to get you more leads using the power of Facebook. That's not bad, is it, Thomas? Back to you.
All right, and I'm Thomas J. Nelson. I'm a residential realtor here in America's finest city, San Diego, California, where I'm never too busy to serve you or your referrals. And you can find me at thomasjnelsonrealtor.com. All right, Rachel. So the tax reform passed in December 2017, just quite over a month ago. What about?
Not quite a month ago.
Not quite a month ago, and then
22nd, I think the president signed the bill.
Yeah. So one of the issues that we're seeing already is the fact that the media covered so much what was proposed to be covered by this tax reform, and they have not covered, in fact, what actually passed with the same vigor. So there's a lot of confusion over the new tax laws. Now, to be fair, the fear-mongering was deliberate and strategic in 2017 because we needed the public to get in touch with their senators and their representatives, and we needed folks like real estate agents to get in touch with their database and, of course, encourage folks that utilize a enrolled agent or a CPA to talk about what's coming up with the new tax laws and to take action. And that is exactly what happened, because what was proposed and what passed are two different things. But in that same vein, the confusion can lead to fear, and fear can lead to paralysis. So we're here to put a little information and fact in place of the fear so that people can move forward in 2018 with a little more clarity on their plans. So, Rachel, I'm going to open up the questions, starting with the mortgage interest deductions. So there was concern that the mortgage interest deduction would be eliminated, and that didn't happen. However, the bill has made a lot of changes, and so let's talk about the most notable changes, and I'm going to turn that over to you.
Okay, thank you, Thomas. And you're absolutely right. There was a lot of discussion, and then there was a lot of confusion towards the end of what was actually going to happen with the mortgage interest deduction. So let's just be clear that for your 2017 taxes that are about to be filed this spring, there are no changes for the return that's about to be filed. So for a going forward basis, we're talking about law that's effective January 1st, so 2 weeks ago, and going forward until it sunsets in 2025. So some of these provisions are temporary until 25 unless they're made permanent. I just wanted to at least bring that up as well.
Right.
So under the new tax law, for starting in 2018, and this is for your personal residence. This doesn't have to do with business or investment properties. So you have to kind of keep that straight, because there was a lot of confusion with clients that called and thought, oh, I'm going to lose my mortgage interest deduction for my rental property. And that's absolutely not true. So keep in mind what I'm talking about right now has to do specifically with your primary residence, the home that you live in. And based on research from Spidell, who is they are a company in California, that's where I get my facts. They're stating that you can take mortgage interest deduction on loans up to $750,000 for a first and a second home, a vacation home, not an investment property or a rental. And there was a lot of discussion about that was going to be eliminated, but based on the facts that I currently have, you can deduct mortgage interest on a first and second home up to $750,000 starting in 2018.
And let me stop you there because I want to be clear on that. So are you saying the combined total is 750 or 750 per personal property?
It is per tax return. So if you're married, then it's $750,000. If you're single, it's $750,000. So it's kind of a marriage penalty in my mind, but it's per return. So if you have, and please also keep in mind that these are loans for what they call acquisition debt. And what acquisition debt is debt that's taken to buy, build, or substantially improve a primary residence or a vacation home.
Right. Okay. So just to be clear, if right now I own one home, I've got a $750 deduction, up to a $750,000 mortgage deduction,
Correct.
I should say. If I decide to buy a second home, and let's just say I buy, my first is $500, my second cost me $250, I'm still well within the $750, or in this scenario, I've maxed it out. But if I buy two $400,000 properties, one to live in, one to vacation in, then only $750 of that $800,000 mortgage debt is deductible.
Correct. The interest on those loans.
So
Correct.
it's okay. And just to be clear, I know this sounds rudimentary, but it's not that if I go out and buy an $800,000 home, I'm not precluded from getting the tax deduction. I'm just not going to get it on the balance of that $50,000 that exceeds the $750.
That is absolutely correct.
Okay. All right. Good. And then just to be clear again, you said that the repeals for this deduction on the interest paid is good through the December 2025.
Yes, December 30th. Yes. Now, keep in mind also that if you currently own a home and your loan is over $750,000, you were grandfathered in under the old rules. And what that means is that you can deduct mortgage interest on your first and second home up to $1 million. Now, your loan had to have originated before the 15th of December in 2017, or you had to be in contract and close before 1/1 of 18 to be grandfathered in under the old rules of $1 million. I know a lot of people were really concerned about that. They were thinking that, oh, I bought my home a couple of years ago. My loan is, $1 million, close to $1 million. What am I going to do? But you are grandfathered in under the old rules, even if you refinance that loan and do not pull cash out.
Okay. Well, and that's another question I had is, does this now make refinancing and doing a cash out refi versus getting a home equity line of credit or a second mortgage, is that a bigger decision now, or under 750, it's the same decision as usual?
So it has changed. So okay. Under the past law, before January 1 of 18, you could have home acquisition debt of up to $1 million and write off the interest on a first and second home. And you could have a home equity line of credit or a HELOC of $100,000. And there were some other little things you had to consider. But you could use the home equity line for pretty much anything, pull it out, pay off credit cards, take a vacation, and you could still write off that mortgage interest on the home equity line of credit. Under the new law, it is not allowed. Home equity debt is not deductible for anyone. No one is grandfathered. It's strictly gone unless that home equity line was used. Let's just say that you pulled out $40,000 to put in a new kitchen in your home, or you pulled out $50,000 and you put an addition on your house. Those would still qualify because they fall under the acquisition indebtedness rules of buy, build, or substantially improve your home. But let's say that same home and equity line that previously you had taken money out to put in a new kitchen, you paid down that loan, and now all of a sudden you pay off your credit cards, that you can't deduct that interest any longer under the new law. So just keep in mind, mortgage interest under the new law is acquisition debt, and in order to qualify for the deduction, had to be used to buy, build, or substantially improve your main home.
Well, and and there are some that would say, I don't want the government telling me how I'm going to spend my money, and in this case, they're technically not, because it's just whether or not you want the deduction. But I have to agree that this seems like a good idea in that the rant I'm always on is your home is not a bank. There are online loan officers out there and companies literally advertising your home's a bank. You go on vacation, buy a car, pay down credit card debt. And that is not what your home was intended to be. First and foremost, it's a home you live in. But if you are going to pull money out, it better be for what you just said, capital improvements. I'm going to do some major repairs, some major improvements.
Roof.
But, and I agree, that's my opinion. But I'm telling you, after coming through the greatest depreciation market in history since the Great Depression, which is in part what got us there, people treating their homes like an ATM. I'm still, dressing battle scars from that era of real estate. So I think this is a good idea. It makes people stop and think.
Right.
Because,
exactly.
And that's my opinion. That has nothing to do with the law, but but it's our show, so I'm going to throw my opinion in. All right. So, and then would you also explain, to what degree it's relevant here, the the alternative minimum tax? It's not just for real estate. So, and we're talking about appreciation and equity. Could you explain that a little? Because I think that's going to have an effect on some of the higher priced markets around the country, especially in places like where I live in California, New York, Florida.
I'm not absolutely clear on how that applies, but the alternative minimum tax is basically an alternative tax system. And when you calculate your taxes, you have to calculate the tax return under the regular rules and under the minimum tax rules. So maybe you're referring to something else?
Well, I kind of introduced that poorly. What I'm talking about is because of this new law affecting properties that are above 750,000, and again, I'm seeing that the biggest pause I think people are going to take are the people that are shopping that 900,000 to 1.25 million home. Based on a down payment, they wouldn't be exceeding the 750 until they get to that realm. Above $1,250,000, they never had that exemption anyhow. So it's that block of people that are most affected. And then where I'm going with this is there are some states where, like, for example, in La Jolla, right next door to my office, it's almost impossible to buy a house for under $1 million. In my hometown of San Mateo in the Bay Area, you cannot buy a home for under $1.2 million. And then on top of that, you own a business, you're filing taxes, and the concern being, well, I've got this new tax law as it pertains to real estate. I've got this new tax law as it pertains to my income. I'm a business owner. That's kind of where I'm going, is the perfect storm of both of these having an effect on an individual. Yeah,
that's absolutely true. In the states with the higher property taxes and the high state and local income taxes really have been predicted to be hit the hardest. It's going to be very interesting to see that the IRS hasn't even released forms for 2018 yet. So we don't yet know exactly how everything's going to how it's going to work and what it's going to look like for everyone. As it pertains to the alternative minimum tax, I know that they've increased the limits and not as many people are going to fall into the AMT as before. There was some discussion about eliminating AMT. However, it is still in effect for individuals. But I don't think that as many taxpayers are going to be falling into the alternative minimum tax, given that they have capped the state and local income tax deduction, property tax deductions, which under alternative minimum tax are not tax deductible. Same thing with the home equity line. The mortgage interest from home equity lines was not deductible under AMT. So I think it's going to be very interesting. I think that people are to be talking to their tax advisors, or I would advise that you talk to your tax advisor every quarter, that you run projections, as the IRS releases guidance as to how the new tax law will be actually translated into onto the tax forms. Because it's one thing to have the written law, there's another thing to actually crunch the numbers and say, what does this really look like for our taxpayers and our fellow citizens?
Yeah, no, I agree. And it's the, I think at the end of the day, I've been selling real estate going into my 19th year this April. And in the 19 years I've been selling real estate, I have never had someone come to me that's a principal property owner and say, I want to buy a house because I want to get that tax break. They want a piece of the American dream. A lot of people, in talking to them, I don't think they 100% feel like they're a success until they not only have that job that's creating some of that success, but they have that house that they're able to say, I'm a part of the American dream. And they're not talking about the tax base at that point. They're not even talking about, the tax exemption. And in fact, I would go so far as to say that they aren't even aware of it until that first year where they're filing and as a homeowner, and they become aware of it. Even though we share that information with them, they're getting information overloaded when they're buying a home. And I don't think in the upper end, people are going to sacrifice buying the home of their dreams if they can afford a $1.45 million home or a $900 to a $1.2 million home. To save $100 a month, I don't see many people willing to sacrifice lifestyle.
I agree with you, Thomas.
So I don't think this is creating the panic and the halt, if you will, in the market that people were Chicken Little predicting. I think there might be a pause for, like I said, that bracket of people that are in that 900 to 1.25 million, because they're going to see the most effect of it. Presumably. Now, again,
correct.
They have to talk to their CPA or their tax advisor, because every person's situation is their own, and we're making general statements.
And not to interrupt you, but there are a lot of other changes to the code that will counteract the loss of some of the other deductions. The tax brackets have been shifted around. They've created a 12% bracket, there's a 22% bracket, a 24% bracket, whereas before it was 10, 25, 28, and so on.
Okay.
I think the effect of the new brackets, and there are also some credits, and for families with children, there is something called the child tax credit that a lot of people were not eligible for in the past. Let's just say, for instance, a married couple with children, if their income was over 110 AGI, they were not eligible for the child tax credit. That's been bumped up to over 400,000 now. So many more people will be eligible for the child tax credit. So let's just say you have 3 children, you're married, the child tax credit now is worth $2,000 per child, and that's a dollar for dollar reduction of tax. That'd be $6,000 off your taxes right off the top. So
okay.
They have implemented some other measures that will help. They've taken some things away. Honestly, it kind of feels to me like they've shifted things around, and hopefully the chips will fall about the same. But they've, in an effort to simplify the code, it feels much more complex to me.
Yeah.
However, as I was talking with Jonathan earlier and saying, if you're an employee and you own a home and your mortgage interest deduction is, let's say your mortgage is $300,000, there's a high probability that you're not going to be itemizing deductions anymore, that you'll be filing a very simple tax return. But it's for clients that have children, who own businesses, who own rental properties, and have homes with mortgages of $500,000 and above, that will be affected by the new changes.
All right. Well, and you're more or less describing me. That's I fall right into that category.
Yeah,
So before we move on, because our next topic, I want to talk about salt, and I'm not talking about the seasoning, but I want to give our wonderful sponsor an opportunity to ply their wares. So Jonathan, I'm going to let you take us to commercial, and then we'll come back and continue on with this very important topic of the new tax reform.
Oh, thanks, Thomas. That's great. Yes, folks, we're going to go for our break. We're going to be back in a minute. We're going to be delving even deeper into the new tax setup. Be back in a few moments, folks. But coming back, we've been talking about the new changes in the tax landscape. It's going to really affect you, your clients, and probably how you're going to do business. And I'm going to throw it back to my great co-host, Thomas.
All right. Thank you, Jonathan. All right. And we're speaking with Rachel Ivanovich from ELM, Easy Life Management, tax preparer. She's an enrolled agent, which is like a CPA with a big Superman cape on. She can do a lot more.
Different things.
All right. So the second thing I wanted to cover is state and local taxes. And you were starting to get into that with the child care expenses having been increased to $2,000 per child. I want to roll it back to now. First of all, am I correct? I read recently that a full 70% of people, at least prior to this tax reform, don't itemize their taxes in the first place. So a lot of this has no bearing on them. It's with a larger standard deduction, that 70% is expected to increase even higher. Would that be a fair statement?
I would say that it really depends on what state you're living in.
Okay.
In California, given our high property tax prices and large mortgages, I think that a lot of my clients pay more than $24,000 in mortgage interest alone. And
right.
Given that that's the new standard deduction for married filers, I think that most of my clients will continue to itemize.
Okay. So there was a concern that the state and local tax deduction, which includes property taxes, would be eliminated. And that did not happen. Am I correct?
Thank you. Yes, that's absolutely true. We were sweating bullets there for a minute.
So the final bill allows an itemized deduction of up to $10,000 for
combined
the total of state and local property taxes and income or sales tax. But there, see, that confuses me. So are you?
Okay, so let me shed a little light on that.
Please.
Okay, so the state and local income tax deduction typically would be, so for instance, let's just use California for an example, given that that's the state that we live in.
Okay.
So let's say that you pay per year $6,000 to the state of California for your state tax. That is a deduction when you itemize deductions. And let's say that your property taxes are $7,000. So in the past, you would have been able to write off a total of 5 plus 12, or what did I say, 6 plus 7?
Yeah, $13,000.
$13,000. That now, under the new law, you'll lose that $3,000 deduction.
Oh, okay.
It will be capped at 10. So that was what prompted the rush to go prepay property taxes.
Right.
In December, was that people were thinking, oh, I need to go pay my property taxes for the beginning of 18 because then I could take that as a write-off in 2017. And then the IRS came out and said, oh, wait, you can't do that. That won't be deductible. And they come, right? And then they came back and said, wait, that is deductible if it had been assessed and you had the bill in hand, which applied to Californians because in, I believe, July, we get the 2 slips and you pay one in the fall and you pay one in the next spring. So don't worry, if you prepaid your April payment, you absolutely can still deduct that on your 2017 taxes.
Okay. Yeah, there was. I remember watching the news in December, and there were lines out the door, and I was thinking to myself, why are they going and standing in line? You can pay them online.
Exactly. So, well, in some states they were not assessed, and so they had to go find out how much they could pay, and unfortunately, the IRS disallowed that. They came out with a statement right around the 26th of December saying, unless it's been assessed and you know exactly how much you are to pay, it won't be counted as a tax deduction for 17.
Okay. Now, another thing that came through, and I want all through this, I'm giving you my understanding of it. I want you to correct me if I'm wrong. Unreimbursed employee expenses and tax preparation fees are no longer deductible. Is that correct?
Correct. So that was on the Schedule A. Those deductions were on the Schedule A, itemized deductions. In the section towards the bottom of Schedule A, which was subject to 2% of income. So what that means is that a lot of people weren't ever even able to write off their tax prep fee or write off their union dues, et cetera, because it got a 2% haircut. So you had to take whatever your income was, take 2% of that, and whatever was over and above that amount was what qualified you for a write-off.
Oh.
So if you had $200,000 worth of AGI, 2% of that is $4,000. So unless your tax bill to your tax preparer was over $4,000, you weren't writing that off anyway. Now, just to clear up some misconceptions, because I had a lot of clients call me in a panic who owned businesses. And their question was, does that mean I'm going to lose all of my business write-offs? That's absolutely not true, because your business write-offs are deducted on different forms. They're not deducted on a Schedule A. Itemized deductions are for personal deductions or unreimbursed employee expenses. So keep in mind that these deductions that now under the new law are gone do not pertain to Schedule C filers, so sole proprietors. Don't worry, you still can write off all your deductions.
Okay, now I'm going to ask you in my world, so an unreimbursed employee expense. So for example, my bride is a flight attendant. She's and there's a lot of expenses that she incurs because she's at work traveling that are not reimbursed by the company that she normally deducts. Those are gone?
Those are gone. Yeah.
Okay. So
my advice to employees is talk to your employer, see what they can reimburse for you, because they can continue to write that off on their through their businesses.
Okay. Yeah. Because I mean, there's certain things that, like, for example, she works for, Virgin America, but they just became Alaska officially. But they require certain things, like, you have to have your nails painted and manicured, and you have to wear certain shoes and only carry a certain color purse. So it forces people to go out and buy things they probably wouldn't normally buy.
Right.
But unless they're getting reimbursed for those purchases by the company, they are now no longer getting the tax advantage of doing that, because that's gone for the next, 5 years, right?
At least, yes.
Okay. And then the tax prep fees, is that across the board? I wasn't clear on that. Like, for example, obviously I pay you to do my taxes and then deduct that expense. Is that gone as a sole proprietor?
No, as a sole proprietor, it isn't. And what I do for clients whose tax returns consist of, let's say, a Schedule C or a sole proprietorship, and maybe they own a rental property or two, most tax advisors will charge based on form. And so I'll break up their tax invoice and say, okay, I charged you $150 for your Schedule C and $100 for your Schedule E. And then you would be able to deduct those amounts of the tax prep fee on those particular forms. The portion of the tax prep fee that is allocable to personal forms is no longer deductible.
Okay. So let's quickly go through a couple other things. Now, you brought up the child care expenses that have increased, but as far as individual personal exemptions, has anything changed with those?
Yeah, so with personal exemptions, those have been eliminated. In the past, taxpayers per, let's say if you're married with 3 children, you would get 5 exemptions. That was worth $4,050. In the past, that is now gone for 2018. You still get a personal exemption for the 2017 tax return. But they, like I said, they have instituted other things to make up for that. And tax credit is one of them. And they have doubled the standard deduction, but they have eliminated the exemption. So in the past, let's say if your standard deduction as a single filer was around $6,000 and your exemption was around $4,000, you could exclude $10,000 from income if you were not itemizing deductions. Whereas now, 18 going forward, you have a double standard deduction of 12, but you do not have that exemption of 4 anymore.
Okay, so
they've given us some things, taken us some things away, changed the tax bracket. And so it's, in a lot of ways, we as tax advisors we're interested to see what the forms are. We'd like to see what the tax tables look like, given that at this point, it's really hard to see how the numbers are exactly going to shake out. And we're doing a lot of continuing education, a lot of reading. I'm listening to the news and just really trying to be prepared as much as possible for my clients this year.
Okay. All right. Fair enough. So some of this still needs to be kind of shaken out. But
And thank goodness we do have the whole year to advise clients. And I've been telling my clients that we'll be talking a lot this year. We need to analyze the situation. The payroll tables and the withholding tables haven't even been changed. So for employees, employers haven't even changed their withholding tables to account for the new tax law, and they won't technically be even using those until February of this year.
okay. So what I'm hearing so far is if you haven't met with a CPA or your tax advisor, or you've been, not to disparage H&R Block, but if you have a more complex filing, this may be the year to start talking to a professional CPA or an enrolled agent like Rachel.
Absolutely. Especially if you own a business.
Yes.
Or if you have a rental property, I would advise talking with an advisor, because the laws for businesses have gotten even more complex. And there are some great deductions coming up that I think are really going to help businesses this year. Very excited about it.
So having Uncle Larry do your taxes might not be the best thing this year.
Exactly. Right. Maybe for 17, but not for the 18
right.
tax year.
Well, I figure you might need a year of prep to get used to it. I mean,
absolutely. I think it's worth paying an advisor at this point.
Yeah. You also mentioned that the tax brackets have improved, allowing everyone to potentially pay less in federal income taxes. Did I hear you right?
Potentially, yes. They have changed the tax brackets. And that's a good point, Thomas, that I did want to bring up, is that California does not conform to any of these changes. So for California, it's business as usual. And for instance, for your bride who spends money out of pocket to do her job, she can continue to deduct those items for California, just not for the federal return. So in essence, we're preparing two returns, one with the federal law and one with the old law under California.
Oh, okay. All right. And then the other thing that was freaking people out, including me, because it was affecting the investment market, or people that wanted to become property owners, in the sense that they had a property that they maybe at one point lived in, then moved out of and rented it out. There was, and what I'm getting at in a very muddled way, is the exclusion of gain on the sale of principal residence. There was a concern that owners would now need to live in their house for at least 5 out of the last 8 years to claim this exemption. Under the former tax framework, a typical owner only had to live in the home 2 out of the last 5 years and would pay nothing in capital gains tax if they sold the house. If
the gains were less than 500,000.
Right. I was just going there. Thank you. Because that wasn't like the Wild West. It was with a total of 500,000. Now, was that is that the 250 for an individual, 500 for a married?
Yeah, it's 500 for a married couple. And fortunately, that was one of the items that they left alone. So the law is as it was. You have to live in and own the home for 2 out of the past 5 years to be able to exclude up to $250,000 per individual. The law stands as it was. Thank goodness. I'm so glad. And that's under Code Section 121 if anyone wants to look it up. Okay.
All right, good. I want to bring Jonathan in. I've kind of taken over the show here. And Jonathan, do you have any questions that we've raised as somebody that's been listening in on this? Anything that we haven't covered that we should talk about?
Not really. I'm very happy for you to take the lead, Thomas.
Well, all right. Well,
Jonathan loves taxes.
Sorry, what was that?
I said you love taxes, Jonathan. Come on.
I like everybody else. I leave it to a true professional. That's so obvious you are, Rachel. So if you're looking for a true professional, after this conversation, I think we've found one for you to deal with your tax problems, folks.
Well, and I was listening to Steve Harney speak. Steve is the founder of KCM. Sorry, I blanked out there. Keeping Current Matters. He's an economist and the founder. And he was, he gave some good advice. He was being interviewed by Tom Ferry. And he said that, because there was so much negativity in the hype of this, which again was fear mongering to get people to step to action. Now his advice was sit down and calm down. The demand for housing is at such a high point that this tax reform bill couldn't stop it if it tried. And he said furthermore that the belief in home ownership as part of the American dream and the road to financial freedom remains extremely strong. And it's just a national fact that the power of home ownership typically reflects in higher income, greater responsibility, which creates better citizens, and a sense of belonging to that American dream. How he summed it up basically was what I always say: the sky's not falling. It's not Chicken Little out there. There's going to be cause to pause and talk to your tax professional, but we're in a housing shortage still, and the demand is still outweighing the supply. And so the law of supply and demand, just like the law of gravity, prevails. Rachel, is there anything that we didn't cover today that you expected to that we should talk about before we wrap it up?
Well, the new tax bill is 1,097 pages, so there are a few more points that we may want to get back together to talk about how the tax bill affects business owners and what to expect for 2018.
I've got just one quick question to Rachel. Because of the size of the bill, do you think that the Internal Revenue have a good grasp about how it will affect all the regulation past and present? I would suggest they probably don't have a total comprehension.
Absolutely not. They don't know. They don't know is my answer. My advice is to taxpayers, contact your tax advisor. And the tax advisors, we're doing our best to interpret the code. As I said, they're still going to be issuing guidance on the new law. The IRS does not know how it's all going to play out yet. We're all doing our best, given that it was passed so late in 2017, to get it up to speed. And it was a really busy December and January, trying to prepare for clients and to render the best advice possible.
Excellent. All right, folks, we're going to do a couple minutes of bonus material on the video. So if you want to stick with us or jump over to YouTube, if you're listening to the show, you can see our show on YouTube and or on the MailRight Real Estate Podcast website. For now, we're going to let Rachel let you know how to get in touch with her, because even though she's based in Carlsbad, she has an international clientele. So don't let that stop you from reaching out. Rachel, if people want more information about this or even your professional help, how would they do that?
Thanks, Thomas. If you have any other questions, please contact my office at 760-730-1817. You can go to our website at elmtax.com. That's ELM like the tree, Easy Life Management, TAX.com. Thank you so much for listening today.
Thanks for being on the show again. And folks, again, just a reminder that if you want to hear more of Rachel's great advice that she's given us over the last couple years, you can find her on episode 91 and 106, and then, of course, today's show 130. Jonathan, if people want to get in touch with you about MailRight, how would they do that?
It's really easy. Give me a call. The phone number's on the website. There's instant chat on the website. Email me or get me on my Twitter feed at Jonathan Denwood. There's a load of ways of getting hold of us, and we love giving advice to agents.
And I'm Thomas J. Nelson with Big Block Realty here in San Diego, California, where I'm never too busy for your referrals or to be of service to you if you just need me as a resource. Happy to share information with you, and you can find me through my website, thomasjnelsonrealtor.com. I'm on Facebook as well as LinkedIn. So come find me and let's talk. And also, if you have suggestions for the show as far as guests you'd want us to have on or topics to cover, you can contact Jonathan and I about that as well, or just leave the comments in our show notes on iTunes or wherever you're listening to our show. And we appreciate you being here, folks, and we'll be back next week with another fantastic guest. come join us for the bonus material on YouTube and wherever you watch our video show. Bye-bye. All right. Well, Rachel, I won't keep you too much longer, but one thing I wanted to cover, because there was a lot of speculation that this was going to, I've already had clients telling me that they're they want to wait and see what happens to the market as a result of this. And I did some research, and there's a chief economist, Mark Zandi, who is over at Moody's Analytics, featured on economy.com. And, he was talking about the 2-year from now effect, because homes are predicted and forecasted to be appreciating by about 4.5% in 2018. And they're going to see a little decline in appreciation in 2019 at 3.5%, but that's totaling 8% in the next 2 years. And the possibility of the appreciation being affected by the tax reform is estimated to be up to 4%. But what people are hearing is that homes are going to go down by 4%. But what they're not applying that to is the fact that from 8% growth, so we're still looking at being up by 4%, not down. What would you say to folks, we kind of covered this, but I want to just drive this point home. The people that are holding back on the purchase or the sale of a property because they're worried about this appreciation, from a tax point of view, what is your take on this, and what would your advice be to folks?
I would say if you like the home and you have the money to invest, to move forward with it, because the tax law is always changing. And they, like I said earlier, they took some things away. They gave us some things, and they changed the tax brackets. AMT has been restructured. There's going to be a new 20% deduction for businesses. So honestly, on the whole, I think things are going to not be as bad as people think. I definitely think that people should consult with their tax advisor, and if they have a financial advisor, this is definitely the year to get one if they don't have one. But I would say homeownership it's the American dream, and I really think that people should continue to move forward with their plans despite the tax code.
Yeah, I agree. I mean, at the end of the day, like I said before, I have never had somebody talk to me about wanting to buy a home because there's a tax exemption. I mean, that's the perk, but that's not the goal. I mean, and I certainly wouldn't let it stop me from getting into the neighborhood or the school district or the niche community, like a golf course community or a horseback, whatever you're into, over a little bit of discrepancy in what you would have saved in the past. I heard it said that when it comes to taxes, there's no good news, there's no bad news, there's just the news. There's just what is today. Because, I mean, if we live in the past, we live in depression. If we live in the future, we live in anxiety. So live in the present.
Absolutely.
Yeah, I think also that it matters what area, because I was just thinking in the lake, because I live quite close to Lake Tahoe, and I have a few local agents, and a lot of people that buy property in Lake Tahoe, it's their second, third, or fourth property that they're buying. So I think these conversations, I don't know what your experience is, Thomas, these type of conversations enter the discussion when you're dealing with somebody and it's their third, fourth property kind of.
Sure. I mean, it's, as Rachel's been saying, every situation's different. I mean, what we're primarily talking about today on the show is when somebody's buying their principal property, the home that they plan to live in. But of course, there's circumstances like that. I mean, I own rental property. I have family that owns property here in Southern California to snowbird to get away from Oregon because they own their principal property in Oregon, but they own a vacation home here. Things like that. So it's the more property you own. I mean, my sister just did it. My sister bought in Nevada. She's becoming a neighbor of yours, Jonathan. Bought some investment property and a second home to vacation in.
She doesn't own guns, does she, Thomas?
No, owns horses.
Oh, that sounds much more safer.
Yeah. Her husband owns guns. He was a retired police officer.
Oh, right. You're not sending him for me, are you?
Yeah. No. Lake Tahoe would be an interesting scenario, though, because I mean, you can work literally in two different states working Lake Tahoe. I mean, you're working the California side and the Nevada side.
It's a
Depending on
very the Lake Tahoe communities are very. I was going to say strange, but that's not the appropriate word. But it's a very interesting, unique, because you literally, with all the contractors that work on housing, they all have to have joint licenses, because literally you're moving over the state literally all the time during the day, weeks that you're working.
Yep.
So it is very unique for that, yes. And actually, when you go there, the casino's on the Nevada side, because the California doesn't allow more than 3 stories to be built.
Oh, okay. Interesting facts about that area. Rachel, before we sign off, have we covered everything that we should have covered today? I know this is still unraveling, but I mean, I think what I wanted to do is kind of clear up the 3 main concerns that I'm hearing from people and kind of remove the fear. Because there, you can remove fear with facts. Have we covered all the facts?
I think that for the most part, yes, we've covered all the facts. I think that people really should keep in mind that there are mortgages for personal residents versus the rental properties, and that rental properties, that laws have not changed. You still can deduct everything on a rental property, all of the property taxes that you pay, and all of the mortgage interest. I think on a Schedule A or itemized deductions, people really need to be thinking, especially in high states with high property taxes, high state and local income taxes, that even though those deductions have been curbed, there are factors that play into them, such as the alternative minimum tax, as you mentioned. The changes may not be as great as we think, given that a lot of higher income taxpayers fell into the AMT anyway, so they were paying the higher taxes and were not getting those deductions, the state and local income tax deductions. So maybe their taxes won't change as much as they thought.
Okay. And, I've, of course, you hear a lot of talk about this, what's behind it. And, some are saying, well, it's just to benefit the rich. And others are saying, though, on a more positive spin, it's to kind of get America to stand up on its own again and get off the teat of the government, and let's see what we can do without the government being so involved. I mean, what's your take on it? What do you think fueled this? And I don't want to open a can of worms, but I mean, just kind of, because I already see Jonathan getting ready to get his soapbox out.
No, I'm not going to say anything about it.
But I mean,
I'm going to keep totally silent.
And I'm not talking about politics as much as just what is the end result they're trying to accomplish with these changes?
That's a very good question, Thomas. I don't really have an answer for you on that.
Okay.
But I do think that I think that a lot of taxpayers will benefit from the changes. I don't think it's going to necessarily be as bad. I think education is definitely good. When I first heard of the changes, I got sick to my stomach and thought, oh, this is going to be terrible.
Yep.
This is really going to hurt a lot of my clients. And of course, I was upset. I was really upset at the beginning. But then I started reading through the literature, reading through the law, and really educating myself on what the changes are. And then I started running numbers and crunching numbers. And that's really what I think people need to do, is to educate themselves. How will this law actually affect me?
Right.
Now, how does this, affect my situation? And I think that on the whole, hopefully people will be pleasantly surprised, especially families with children. I think that the enhanced child tax credit is great. Really excited about that. I think it's going to help a lot of families. I think that, the changes to the tax brackets may help. And I think that people just need to inform themselves and really look and see how the law applies to their situation. And I've said this again and again, is that they've taken some things away. They've given us some things, and that people really need to see how the new tax law will apply to their situation.
So let the numbers do the talking, and don't. The worst thing you can probably do is compare yourself and to other people, because you don't know their situation, and you end up commiserating with someone that may not even have the same effects that you're experiencing. So I think the best advice that we've given out of this is now is the time to get with a tax professional, especially if you own a business and rental property or multiple properties. Even though this doesn't take effect to your 2018 tax year, my advice, just from someone that's gone through changes with CPAs, is give yourself a year to get used to who you're working with, so that when all these changes do take effect, you're not getting to know this person for the first time at that time.
Yeah.
All right, Rachel, one more time, let's tell people how to get in touch with you.
Please call me. I'm happy to answer any questions. Rachel Ivanovich, Easy Life Management. Our office line is 760-730-1817. Thank you.
And Jonathan, how about you?
I'll just go to the MailRight website. All the contact information is on there.
All right, and I would love to hear from you at 858-232-8722, or through my website. You can email me or get in touch with me through my social media links at thomasjnelsonrealtor.com. I'm with Big Block Realty in San Diego, where I'm never too busy for your referrals. We certainly appreciate you spending each week with us here on the show, folks. We'll be back next week with a fantastic guest. Rachel, thanks again for joining us and helping us kind of plow through some of this. Not only the fear factor, I think we've made a little more sense of this, and given some good advice along the way. So thanks for being a resource to our show as usual.
I'm happy to help. Thank you, Thomas. And thank you, Jonathan.
Right.
All right.
Bye, folks.
See you next week. Bye-bye.
All right. Bye-bye.